Hi, Dale. I'm thinking of taking out my IRA. It's about $100,000, and I was wondering what would I do to offset the taxes and penalties?
Well, you can go out and buy yourself a large piece of real estate, like an apartment complex. What I tell people to do is go out and pull your IRA money out early in the year, January, February, March, something like that, so that you have a whole year's worth of depreciation to take against it. Secondly, buy yourself as large a property as you can, as leveraged as you can, so that you are going to have a lot of real estate to depreciate. Third, I would do something called cost segregation. Cost segregation is going to double, if not triple, the amount of deductions that you can take. I just use the straight line method. For example, on $100,000, you typically get to write off about $3,100. But with cost segregation, you would get to depreciate double that, so that it would be more like $6,200. Or on $1 million piece of real estate, for example, if you put 10% down on that, about $1 million, you'd get a $31,000 deduction, or a $62,000 deduction. Now, let's say that property didn't make any money the first year. Now, that's not typical situation, but let's say it didn't. That whole $62,000 could be applied to your personal income tax deduction if you were a real estate professional. But if you were not a real estate professional, the most you could put against your earned income would be $25,000 anyway. So there's a lot of things that come into play here. It becomes more complex when you're trying to cover income from ordinary income, and that's what IRA income is. It's ordinary income. So it's harder to cover ordinary income unless you already have a lot of real estate in place. But you can also roll those, you can take that accelerated depreciation and you can go backwards over those years, maybe 2 or 3 years, and catch the rest of that $100,000 you couldn't get the first year.